Hi, I'm Neil Insko with Equity. We deliver success strategies for your business. Today, we want to talk about income taxes. More importantly, we want to talk about saving income tax. We want to talk about a loss test. The loss test is how much to determine how much unnecessary income tax you are paying. And we want to be able to do that if we can before the beginning of the year. So let's look at how we determine this loss test. First of all, we want to look at your personal income need. And your personal income need might be, say, $10,000 in my example. That's what you need to pay your mortgage, to be able to pay your utilities, for cleaners, for all the things just for you to personally live, not including contributions to your retirement plan or any taxes that you'll pay. My number here is $10,000. We want to take that times 20. Now we're taking that times 20 because we want to determine exactly how much money we're going to need to live on and pay taxes. This is at a 40% tax bracket, which means that you now need $200,000 to be able to live on each year. Not only to take the $10,000 a month, but also to pay the taxes. So that equates to $120,000 to live on and $80,000 in taxes. This is determined at a 40% tax rate. Now, many of you say that you're not in the 40% tax rate because you live in a state like Nevada or Florida or Texas that don't have state taxes. And actually, you're wrong. You do have additional taxes higher than your tax rate. You have gasoline tax, you have property tax, you have sales tax. You basically have tax on tax. So the idea is that we're going to use 20 to have a 40% tax rate to determine our taxes and our income need. Next is that we have our gross business income. Let's say our gross business income for the year is $300,000. That would mean that our business made $300,000. If it cost us $100,000 to be able to run our business, we now have a pre-tax business income of $200,000. Now, what is our need? Our income need is $200,000. And we made a pre-tax profit in our business of $200,000, so we have zero surplus at the end of the year. If our business gross income was $400,000 and it cost us $150,000 to run our business, we would have $250,000 available, of which $200,000 we would need in order to create income for ourselves and pay our taxes. That would mean we'd have a surplus of $50,000 available. If we paid tax on that $50,000 at 40%, we would have $20,000 in tax if we paid the tax, and we put $30,000 in our pocket. What we want to do is, once we determine the surplus, we want to be able to take the surplus and be able to put it someplace on a tax-deductible basis to save it for retirement or for some other source. So what's the problem? The problem is that we've got to determine how much unnecessary income tax we're paying on an annual basis. The solution is creating a loss test. And I know that once you determine exactly what your income need is, what the loss test can show you what your surplus is, it will help you to determine more money that you can put away for things such as retirement. At Equity, we deliver success strategies for your business. If you're interested in anything that I've talked about in my presentation today, please send me an email at neil@getequity.com. And that's equity with an I, EQUITI.com. Or feel free to contact me at 858-344-5110. Thank you for watching this presentation.